Kevin, though, is the cut already priced in? And is it all about kind of what we get in terms of the summary of economic projections and whatever commentary we might get for the new year?
Well, yes. I think if you look at the WIRP function on the terminal and then compare that to...
We love that function.
Yes, pricing, for December, actually relative to the equity market, if you look at it over the past month, both of those have been neck and neck. So, I would say it's fully priced in the sense that, every time the probability of a cut has increased sharply, the market's done well and vice versa. I think beyond that, one of the reasons I think that we're probably not going to see as many cuts next year is because the inflation backdrop, and we're putting out our outlook at some point later today, but I think that the inflation backdrop is going to be a little bit trickier in the sense that there's probably some upside inflation risk from tariffs that are expected to stay high, which have already put upward pressure on goods prices, but also fiscal stimulus coming from the big, beautiful bill. And I think still even if it's a wobbly, but still relatively resilient labor market that keeps people spending on a month-to-month basis. If you add all of that together and put it into an equation, I still think you have upside inflation risk. Plus, from a personnel standpoint for the Fed, you have to keep in mind that 2 voting members rolling onto the voting committee are the heads of the Cleveland and the Dallas Feds, and they've been leaning much more hawkish recently. It's Beth Hammack and it's Lori Logan. So I think that needs to be taken into consideration when you think about, especially the emphasis that has been now pushed on individual member commentary. That hasn't been the case up until maybe the past couple of months, where we've been paying so much attention to what each individual member has been saying. Now there's much more focus on that. So I think for those reasons, you probably don't get as many cuts next year as maybe some people have been expecting.
A narrative around that. What do you think, Matt?
I mean, it's we're looking at, with the WIRP function, getting down to a terminal rate of 3% even, basically, right? Between 3 and 3.25 right now. So that's moved up a little bit. And as we hear so much about the economic growth that we're expecting next year, as we hear so much about the stimulus we're going to get from one big, beautiful bill, I just wonder if it's going to be hard to even go that low. Because inflation, if you look at CPI, it's going the wrong direction, and it's 50% over the Fed's target.
Yeah, we're averaging closer to 3%. That seems to be, more like the floor. Even if you don't go, because it's not our expectation that you go back to anything akin to 2022 or 2023. I mean, getting close to, 8-9% on CPI, barring some major shock, is just really not in the cards.
But we've been there, so this only 3% still hurts.
Well, but exactly. So
because
I think
prices haven't gone down, right?
Yeah. And you're now 4.5 years of the Fed being above its target. I think at some point that has to come into the equation, and it'll matter in terms of how they set policy. So really, I mean, this is just them getting closer to neutral, what they think of as neutral. If it happens to be the case that inflation pressure is reaccelerating and they're maybe too close to neutral, then you can maybe start talking about a hike. I think it's still a little early for that, but you just have to keep in mind that they've been now so far above their inflation target for so long, and labor has essentially been at target almost the entire time. I mean, 4.4% for an unemployment rate. Yes, it's risen over the past year, but it's been number 1, gradual, and number 2, consistent with a fully employed labor market.
30 seconds. So what does this mean for the equity markets? I mean, if there's earnings, if there's an economy that's growing, if the labor market doesn't fall apart?
Well, the earnings picture just by itself, I mean, if you look at every sector so far, there's expectations that you're going to get pretty solid earnings growth for all 11 GIC sectors in the S&P. Only 3 are expected to have earnings growth that is slower in 2026 relative to 25. So that in and of itself just shows you that it's not just a couple of sectors or even a couple of industries that are carrying the market higher from an earnings standpoint. It really has broadened out. So we think that from an index perspective, maybe it's not as great because if you don't have the mega caps contributing mostly to the gains, then the index performance might not look great, but you could have relatively healthy breadth under the surface and participation that could mean for maybe a better year for equal weighted relative to cap weight.